Good morning. Welcome to the Techno Fundamental Report for March the 9th. Bull market, bear market, kangaroo market. Sometimes the market gets stuck in either an uptrend or a downtrend, but sometimes it's basically stuck in a sideways motion, which is very frustrating because if I go back to last summer, to last year, you can see, we come down, we bounce, we come down, we bounce, we come down. So we're in one of those types of markets. Now, when it comes to investment strategy, and we talk about long-term investing, consistency is the key, because I always recommend that people adopt an investment strategy that they understand, because if they understand the strategy, they're going to stick with it during difficult times. Now, like a dog chasing his tail, you can really get stuck in a situation where you adopt a strategy, the strategy quits working because the market is difficult. You abandon the strategy, you go to a different strategy, and by the time you go to the different strategy, your old strategy starts to outperform, and the strategy that you adopt starts to underperform. So the most important thing here is to stay consistent. Now, I wanted to go back in time a little bit. This is what the Fed is really worried about. The Federal Reserve is saying that when they look at the 1970s, 1980s, the inflation had to be stopped by Paul Volcker when he raised the discount rate to 20%. And this is the 30-year Treasury yield actually got up to over 14%. And then once rates peaked and came down, you can see this point right here, the market really took off into one of the best bull markets we've ever seen. But as you can see, going into it, in that early period, now I'm talking about, starts out here in 1964 all the way out till 1982. This was that kangaroo type of activity, that basing pattern. Now, as I developed my strategy, I said, okay, what could I have done back in the 70s and early 80s that could have dealt with this problem? Because if you were indexing or just in the S&P 500, it was very frustrating. But if you found a company called Walmart, you got rich. So the key to it was with Walmart. It was just a small company out of Bentonville, Arkansas. No one had really heard of it, but they were growing. Their earnings were growing, their cash flow was growing, etc. Now let's look at the market as we stand today. New highs. This is a graph of new highs on the S&P. We're just not seeing any. This indicates to me that we kind of got a void of buyers. We just don't have a lot of buyers. Now, when you get into one of these bottoming situations where the sellers are pretty much done, now we got to get the buyers to come in. Now, I wanted to just look at a couple of these indexes that we look at. We look at 5 indexes. Small caps have broken down below that lower moving average, so this is kind of a risk-off situation here. So the small caps have somewhat broken down. Now, in the 2 major big indexes, they're holding, this is the S&P, they're holding that 200-day moving average. We really want to see it hold, get into an uptrend, and see that lower moving average turn up. Now, here's the NASDAQ, same story. We're just not seeing a turn up, and this has been somewhat of a correction that started once we got that jobs report, which was way over estimates. You can see that the fear of the government the Fed raising interest rates has really been the problem here. The market's going down for one reason: interest rates going up. Volatility index, we do a 50-day moving average on the volatility index, actually looking quite good. That is a positive. On the aggression index, we're actually looking okay there. We're above the lower moving average. The lower moving average has turned up. In fact, we're very close to getting a golden cross. Now remember, this is a ratio of growth stocks compared to consumer staples, which is usually considered value stocks. So as you can see here, back in this period here, actually February of 21 is where we got that sell signal, and we've been pretty heavy in cash ever since because the growth stocks just aren't performing. Hopefully that's turning. Now, in our 3 economic indicators, I really find it amazing that the 10-year Treasury note, basically got up over 4%, but then backed off. I really can't understand why interest rates just don't really go up a whole bunch, but the market's discounting something. Now, this is oil. Oil is in a downtrend because it's below that 200-day moving average. Now, interest rates are in an uptrend because they're above the 200-day moving average, and you can see that's an uptrend. Now, in the financial stocks, meaning the banks, insurance companies, kind of rolling over here, during this current correction we're having. New lows continue to be okay. However, we're getting a little bit of an increase here, up to 49 new lows. We want to continue to see below 40 a day. So that's starting to kind of perk up a little bit, which is not a positive. Now, I did want to mention something here. This is the bull-bear ratio. Now, remember, AAII is an association of 1 million members. And every week they do a poll. Are you positive or are you negative? And as you can see here, when you're below zero, everybody's negative. So if you're negative on the market, well, so is everybody else. So we get it. Now, all of a sudden, there was a spike in optimism here that quickly faded. That can be a positive because as a contrarian, you want to see that pessimism coming in. Now, on bonds, we're looking at that corporate bond fund, the HYG. You can see here, once we got that jobs report, things really failed. However, starting to stabilize a little bit here. Actually tried to break out. Not looking that bad, so maybe interest rates, we'll just have to see. Now, on the government bonds, the same thing. You can see here, here's the jobs report. Things came down. By the way, we're going to get a new jobs report tomorrow, so just, be aware. We're hoping that it kind of shows that things are cooling down a little bit on the job market, but they're estimating 225,000 new jobs. If that's over 250, it could be a problem for the bond market and the stock market. But you can see here that, we got that kind of a real shakeout and then a pullback. Now, I wanted to mention this stock this week as we look at our fundamental analysis of various companies. Last week we did on United Rentals. We're seeing kind of an interest in building materials and industrial type stocks versus the usual technology retail stuff. Well, you can see here this stock broke out. It's above the 10-day moving average, kind of rolling over here a little bit, so you might want to keep an eye on it. But the numbers are pretty darn good. Let's look at the numbers real quick. This is as of the most recent quarter. Profit margin 12%, very good. Return on equity is an exceptional 56%. And that's important because we always look at the debt number. They do have quite a bit of debt. They have $3.5 billion in debt. Their debt to equity ratio is 70%, but if you can get a 56% return on equity by leveraging the balance sheet, sometimes that can make sense. And in this case, we think it does. So just kind of keep an eye on it. Positive cash flow, things are looking good there. So if we look at who the CEO is, his name is Dave Rush. This company's in Dallas, Texas. They mainly, they supply builders and so forth with building supplies. They actually manufacture building supplies. But I think the most important thing here is we've learned over the years that exceptional CEOs are really good at capital allocation. So the fact that this guy has a degree in accounting could be a positive. So Dave Rush is the CEO of Builders First Source. Interesting company. If you have any questions, let me know. Thank you very much.